If you want to understand silver, you cannot begin with silver, you have to begin with the dollar. That is where most people go wrong. They look at silver as if it were some eccentric side asset, a shiny relic for people who enjoy old coins, apocalyptic headlines, or dramatic stories about collapse. They think the real system is modern money. And silver is just a leftover curiosity from an older world that never quite disappeared, that is backwards. Silver is not strange, your dollar is strange, that is the mother line. A dollar used to mean something very specific, not a slogan, not a policy promise, not a mood, not confidence in a central banker. It meant a weight of metal in the early life of this country. A dollar was legally defined in silver. It had a body, it had measure, it had substance, it could be weighed, counted, tested, and understood without needing a speech from the government to explain what it was worth. That matters more than people realize, because when the definition of money changes, everything built on top of it changes too. Most people live inside the new system without ever asking what was removed. They accept the word dollar without asking what the word used to anchor to. And if you never ask that question, then you will misunderstand not only silver, but inflation savings, debt purchasing power, and the quiet violence of modern money itself. That is why I do not treat silver as a metal story. First, I treat it as a memory test. Do you remember what money used to be before governments learned they could redefine it faster than they could restrain themselves? The source document opens exactly where it should, with the old legal definition of the dollar. I like that because it forces the audience to confront something deeply uncomfortable. A dollar was once a measured quantity of silver. Today, it is whatever survives policy, politics, deficits, and confidence long enough to keep the system functioning another year. That is a massive change, and most people never stop to mark the distance. That is the first mechanism I want you to understand. I call it the definition break. Once money stops being defined by something scarce and physically constrained, it becomes easier to create, easier to dilute, and easier to abuse. That does not mean every fiat currency dies tomorrow. It means the discipline once imposed by metal no longer exists in the same way. The old system demanded that the issuer respect the scarcity of the anchor. The new system mainly demands that the public keep believing. That is a very different kind of order. Belief can last a long time. It can also be stretched much farther than people imagine now. I want to be careful here because I do not romanticize the past mindlessly. Metallic systems had real problems. They were not perfect. They could be politically manipulated, regionally restrictive, and sometimes too inflexible for fast-growing economies. Fine, I do not need a perfect mythology. What I care about is the discipline that came from a world where money still had to answer to weight. That discipline is gone. And once it is gone, the temptation changes. Governments no longer need more silver or more gold to create more claims. They need political permission, central bank cooperation, debt markets willing to absorb issuance, and a population not angry enough to reject the consequences. That is a looser world, and a looser world eventually forces people to ask what can still hold value when the definition of value itself becomes more elastic than it used to be. That is where silver returns. But before silver can return as a present answer, it has to return as a historical fact. The source text spends real time on this, and it is important. Silver was not some minor footnote in monetary history. It was daily money for civilizations long before the modern state taught people to trust paper abstractions and digital balances. Gold was too scarce for ordinary exchange in much of everyday life. Silver sat closer to the ground. It was the people's metal, the practical metal, the transaction metal, the reserve metal of ordinary commerce. That was true for centuries because silver solved the problem gold alone could not solve. You need enough money in circulation to run an economy, and silver made that possible. That is why the old Spanish dollar mattered so much. That is why the piece of 8 mattered. That is why the American dollar borrowed its own conceptual identity from a silver world before later regimes severed the link and kept only the name. That is not trivia. That is a confession hiding in plain sight. We kept the language, we removed the anchor, and then we acted as though nothing fundamental had changed. That is the second mechanism. I call it the nickname problem. People still use the old word for a new thing. They hear dollar and imagine continuity. But continuity in name does not mean continuity in substance. If you rename a promise after an object, the promise does not become the object. It only borrows the object's credibility for as long as the public forgets the difference. That is exactly what happened with money. The source document points to the Coinage Act of 1792 and then to the long demolition that followed. Good. Those are not just legal milestones. They are stages in a philosophical transformation. First, a defined silver dollar, then a bimetallic balancing act, then the demonetization of silver, then the progressive narrowing of what counts as money, then the final severing from precious restraint in the Nixon era. Every step moved the system farther away from weight and deeper into trust. And once you understand that sequence, you stop treating modern monetary decay as some mysterious accident. It was the natural consequence of a chain of decisions that made money easier to issue and harder to discipline. That is why I take the so-called crime of 1873 seriously, even if some people roll their eyes at the phrase. You do not need conspiracy theater to see the core issue. Remove silver from official monetary standing and you contract the monetary base relative to what it might have been. You strengthen the hands of those closest to scarce capital. You make debt burdens heavier in real terms. You alter who gets squeezed and who gets protected. Those effects are not imaginary. The names change, the pressure does not. And then 1971 completes the moral transformation at that point. The last meaningful metal restraint on the dollar is gone. The dollar is no longer even pretending to answer to gold or silver in the old way. It becomes a state instrument whose value depends on policy credibility, power projection, debt absorption, and public faith that tomorrow, S-claim will still buy enough to keep the machine socially intact. That is not money in the old sense. That is managed trust. This is the third mechanism. I call it the trust substitution. Modern money asks you to accept that discipline can be replaced by administration. That is a very ambitious request. Sometimes it works long enough that people stop noticing the substitution, but the longer the system runs, the more the hidden costs emerge. Prices creep, then surge savings, lose purchasing power quietly, asset prices rise in nominal terms, and people confuse that with wealth. Debt becomes easier to tolerate politically because repayment can be diluted rather than earned. Honestly, the currency still functions. Yes, it simply functions in a way that transfers value invisibly more often than people are willing to admit. That is why I say if you do not understand silver, you do not understand money, because silver reminds you what was removed. Now let us shift from the monetary story to the supply story, because this is where the source document becomes even more important. A lot of silver commentary stays trapped in history and never reaches the present. That is a mistake. Silver is not just a historical corrective. It is a modern collision. That is what makes this setup so unusual. Gold can live almost entirely as monetary insurance. Silver cannot. Silver lives a double life. That is the fourth mechanism. I call it dual identity. Silver is still bought as a store of value and monetary hedge, but unlike gold, it is also consumed relentlessly by the industrial world. That makes it much more complex. And under the right conditions, much more explosive. Metal that protects against monetary disorder while also being physically required by future technologies is not a normal asset. It becomes a bridge between two kinds of pressure at once. That is why silver matters so much right now. The source file says roughly 60% of silver demand is industrial. That is the point that casual precious metals people still underappreciate. They want silver to behave like small gold. It is not small gold, it is monetary metal plus industrial input. It sits in solar panels, electronics, EV systems, semiconductors, advanced circuitry, thermal management, medical uses, and all sorts of less glamorous applications that the public never sees clearly because silver is used in small amounts spread across immense systems. That distribution matters. A metal used in micro quantities across billions of devices can disappear economically faster than people realize. Gold is hoarded. Silver is often consumed. Gold sits in vaults, jewelry, and reserves. Much of silver ends up scattered through technologies in concentrations too small or too costly to recover efficiently. That changes the supply story entirely, and it is why I care less about above-ground existence in the abstract and more about recoverable, economically relevant silver in practice. This is the fifth mechanism, I call it, irreversible consumption. A lot of people still think metals are metals, dig them up, melt them down, store them, recycle them, and there they are. That is much truer for gold than for silver. Silver gets used not metaphorically, physically, a little here, a little there, spread through products where retrieval is technically possible but economically silly. Once that happens at enough scale, the supply available to meet future demand becomes tighter than naive inventory numbers suggest. That is why the source document's emphasis on 6 straight years of deficit matters so much. Deficits are not just annual news items. Repeated deficits tell you the market is consuming more than miners can supply. The shortfall has to be met somehow. Stockpiles, exchange inventories, ETF outflows, private hoards recycled material, something gets drawn down to close the gap. If that happens year after year, the market is not living on stable balance. It is living on depletion. That is a very different thing. Now, if supply is tight and demand is strong, why does the system not simply produce more silver? Good question. The answer is one of the most important details in the whole thesis. Silver supply is structurally awkward. This is the sixth mechanism. I call it byproduct captivity. Most silver does not come from pure silver mines. It comes as a byproduct of mining for lead, zinc, copper, gold, and other primary metals. That means the decision to expand silver supply is often not made based on silver economics alone. If copper economics weaken, silver output can suffer even if silver itself is screaming for more supply. If a new silver-heavy project is discovered, it still takes many years to permit, finance, build, and ramp. And if environmental, legal, and political friction intensify, the timeline stretches even further. That makes silver supply inelastic in the short and medium term. And inelastic supply meeting rising demand is exactly the kind of setup that can create violent repricing once the market truly pays attention. The source document is right to emphasize solar, EVs, AI infrastructure, and semiconductors because those are not one-cycle curiosities. They are system-level demand trends. Governments are pushing solar hard. EV adoption is still structurally rising over time despite uneven consumer enthusiasm. AI data centers are consuming more electricity, more chips, more thermal control, more electronic complexity. All of that presses against silver demand one way or another. And what makes this especially interesting is that the industrial side of the silver story does not need the monetary side to work perfectly. If the world keeps electrifying, digitizing, and hardening its technology base, silver gets pulled. If the monetary system keeps being stretched, silver also gets pulled. That is why I say this is a collision, not a single narrative. Two, this is the seventh mechanism. I call it converging demand. A lot of assets depend on one dominant story. Silver can benefit from two very different stories at the same time. Monetary distrust pushes one side, industrial necessity pushes the other. That does not guarantee a straight line moonshot. Nothing does, but it does create a rarer setup than people usually find. The monetary people underestimate the industrial floor. The industrial people underestimate the monetary acceleration. When both begin pressing together, the repricing can become much more violent than the market is comfortable with. That is why silver feels so misunderstood. The gold crowd often treats it like a sidekick. The industrial crowd treats it like an input. The average investor treats it like a volatile antique. Very few people hold the full picture in their head at once. That creates opportunity. Now let us talk about the gold-silver ratio because I want to preserve that spine from the source material too. The ratio matters not because it is a magical oracle, but because it gives you a way to judge relative stress between monetary metals. When the ratio is very high, silver is often historically cheap relative to gold. When the ratio compresses sharply, silver is often in an outperformance phase. The ratio does not tell you the future with certainty, but it tells you something about relative neglect and relative excitement that matters because silver tends to be the more emotional metal. Gold gets bought first as reserve insurance. Silver often gets bought later, harder, and with much more violence once the trade broadens. That is why the ratio can move so fast in silver's favor once the market wakes up. But I do not want to turn the ratio into religion. It is a signal, not salvation. This is the eighth mechanism. I call it the catch-up lever. Silver does not always lead. Often it lags, it drifts, it frustrates. It tests conviction. Then, under the right conditions, it starts moving faster than the thing it was lagging. That is what makes it dangerous and attractive at the same time. A person who buys it expecting gold like calm will be disappointed or terrified. A person who understands that silver is a higher volatile response to both monetary and industrial pressure will be much less surprised by the wildness. And that wildness is the price of admission. Now let me say something very important about risk because the source document is right not to sell a fantasy. Silver can hurt people. It is volatile. It can fall hard. It can spend long stretches doing nothing obvious while inflation deficits, money printing, and industrial demand all appear supportive. It is not a line from logic to price. It is a battleground. Rates matter. The dollar matters. Sentiment matters. Risk appetite matters. The futures market matters. Positioning matters. Technology can reduce silver use per unit in some applications even while total demand still rises. Substitution risk exists. Mining responses can surprise. Nothing about this is risk-free. That is why I hate two kinds of silver people. The first kind thinks silver is obsolete. The second kind thinks silver is destiny. Both are lazy. Silver is not obsolete, and silver is not owed to you. It is a high volatility, structurally important, historically monetary metal sitting inside an unusual modern setup that is the correct level of seriousness. Now let us deal with one more misconception. People say silver is poor man. Gold. That phrase used to sound clever. Now it mostly sounds ignorant. Gold is mostly a monetary reserve asset. Silver is monetary plus industrial. Gold is held, silver is held and used. Gold is slower, silver can be much more explosive. Gold protects first, silver can protect and leverage. That does not make silver better than gold in every portfolio. It makes silver different in a way many investors still have not priced emotionally or conceptually. And the more the future belongs to electrification, digital infrastructure, AI hardware, and forced energy transition programs, the harder it becomes to dismiss the industrial half of the case. That half is real. So here's where I come down. If you do not understand silver, you do not understand money, because silver forces you to ask what the dollar used to be, what it became, and what happens when a monetary system based on trust collides with a metal that is both a historical form of money and a disappearing industrial necessity. That is a serious collision. The dollar no longer answers to weight. Silver still does. Governments can issue claims faster than they can issue restraint. Silver cannot be printed. Industry keeps consuming silver faster than fresh supply replaces it. Silver supply is structurally slow to respond. And most investors still speak about the metal as if the world has not changed at all. That is why this matters. Not because I think silver is a toy for cranks, because I think silver is one of the few assets that still teaches the whole lesson at once. What money was, what money became, what technology demands, what scarcity does, and how quickly the market can move once it realizes an old monetary metal is no longer merely sitting in history, but standing directly in the path of the future. That is why I respect it. Not because it shines, because it reveals. And in a world where most people still confuse currency with money, any asset that reveals the difference deserves much more attention than it usually gets.